We all have one of these little plastic cards in our wallet, right? But do you really know how the companies behind them make their money? Today, we're going to pull back the curtain, and I'll give you a hint. It's a whole lot more than just charging interest.
So if I asked you how they make money, you'd probably say it's from the interest people pay when they don't clear their balance. And look, that's a huge piece of the puzzle for sure, but it's not even close to the whole story.
Get this, even if there was a law that capped credit card interest at 10%, the big banks would still be raking in billions of dollars in profit. That right there tells you something else is going on. So where's all that other cash coming from?
Okay, to understand this, you first have to know that it's not just one company running the show every time you swipe your card. There are actually two key players operating behind the scenes.
First up, you've got the issuer. That's your bank, the Chase, the Capital One, the company that actually gave you the card and sends you the bill. Then you have the network. Think Visa or MasterCard. They're like the payment highway that connects your bank, the store's bank, and makes the whole transaction happen. And yep, both of them get a piece of the action.
So the first big moneymaker is something you will literally never see on your statement. It's a kind of hidden fee that gets charged on every single swipe.
Here's how it goes down. When you buy something with your card, the store, the merchant, has to pay a small fee to process that payment. It's called an interchange fee, and that money gets split between your bank, the issuer, and the network, like Visa.
So on, let's say, a $100 purchase, the store might pay somewhere between $2 and $3 in fees. Now, that might not sound like a lot, but just think about it. Multiply that by the billions and billions of transactions happening every day. It becomes a massive, massive river of cash.
And this right here explains something you've definitely seen before. You ever wonder why that local pizza place offers a discount if you pay with cash? Or why some online businesses tack on a convenience fee for using a card? Now you know. They're just trying to cover the cost of those interchange fees.
All right, now let's talk about the big one, the part of the story we all know. Interest. If interchange fees are a constant, steady drip of revenue, then interest is the fire hose. It is, by a huge margin, the industry's #1 moneymaker.
I mean, just look at the numbers. The Federal Reserve says that a staggering 80% of all credit card profits come from interest charges alone. That means all those other fees we're talking about, they make up just 20% of the pie.
And here's why it's so incredibly powerful. The average interest rate, or APR, on a credit card right now is hovering around 22%. That is an insanely high rate for borrowing money, especially when you remember that this interest compounds daily. Let me show you how fast that gets out of hand. Let's say you have a $2,000 balance, and we'll even use a low 10% interest rate. If you make $100 payments every month, it will still take you almost 2 full years to pay it off, and you'll have paid nearly $200 just in interest. Now, just imagine doing that math at 22%.
Okay, so beyond the swipe fees and the massive interest charges, there's a third bucket of revenue. These are all the other fees, the ones that are usually buried deep in that fine print, but man, can they add up fast.
You've got your annual fees, right? Sometimes hundreds of dollars just to have a fancy rewards card. Then there are late payment fees, which can sting you with a $40 penalty for being just a day late. Balance transfer fees, which take a 3 to 5% cut right off the top of any debt you move. And of course, foreign transaction fees if you dare use your card overseas. They might seem small one by one, but they're designed to nickel and dime you.
Now listen up. While you should know about all these fees, there is one you need to avoid like the plague. The cash advance. It is a terrible deal. You get hit with a high fee up front, you're charged a way higher interest rate, and that interest starts piling up the instant you take the money out. There's no grace period. It is without a doubt one of the most expensive ways to borrow money on planet Earth.
So after all that, now that we know how they make their money, how can you flip the script and use this whole system to your advantage?
It's actually pretty simple. Rule number 1, the golden rule. Pay your balance in full and on time, every single month. If you do that, you pay exactly $0 in interest. End of story. Second, if you do have debt, use a 0% balance transfer offer to your advantage, but you have to have a plan to pay it all off before that intro period is over. And finally, pick a card that actually matches how you spend your money, not just the one with the biggest sign-up bonus.
Really, it all comes down to this. You have to treat your credit card like a convenient tool, not like an easy loan. When you see it as a tool to make purchases you were going to make anyway, you get all the perks, the rewards, the fraud protection, with none of the downsides. The second you start treating it like a loan, the bank starts winning.
So here's the bottom line. Credit cards are engineered to do two things really, really well: reward people with financial discipline and punish those who are ignorant of the rules. Which side of that equation you're on, well, that's entirely up to you.